Let's calculate the stock price for Party City. Now first, we'll get their market cap, 79.3 million. And their stock price is 0.8391. And that means they have 95 million shares outstanding. So when we figure out the value of the company, we have to divide it by 95 million. So first we're going to start with the free cash flow. And this is how someone calculates the value of a company. What they do is they estimate the future free cash flow and discount that back to today's dollars. And that's a traditional discounted cash flow model. And they use cash flows because that's what's left over after operating the business each year. Then they use net income because net income is not as reliable of a number due to a lot of the depreciation and other things involved in net income. So it looks like they only had 1 year of negative free cash flow, and that same year they had a negative $500 million of net income. But other than that, it's all been positive. So let's calculate that capital structure because every company borrows at a different rate, and we have to see how much they borrow at so we know what to discount the cash flows by. They don't have any interest expense. So does that mean they have no debt? 200 million of current debt. And non-current debt, 1.5 billion. Now let's interest expense. They're not paying any interest on the debt. That's really interesting. They may negotiate it with their creditors not to pay interest, but we see debt on the income statement in 2017. So let's input that interest payment. Okay, so that implies a 5% interest rate on the debt. So that sounds about right. And let's get their effective tax rate. So we have to go to 2018 for that because they took a loss in 2019. So they pay 24% taxes. So we have to discount the 5.13% by 24%, and we get a 3.9% cost of debt. They are highly leveraged. 96% of the capital structure is debt. That's why they probably didn't pay any interest. They had to negotiate the terms with their creditors because they probably couldn't afford to pay the debt. Probably has a high beta also. That's a really high beta, 2.66. So this company is struggling. Their cost of equity is 23%, and their cost of debt is 3.9%. So the WACC is a combination of debt and equity. And the WACC is low because they have so much debt. 4.73% is their WACC. And that's what we have to discount the future cash flows by. So we're coming up with a value of the company of $2.9 billion. And when you divide it by 95 million shares, that implies the stock price is $31 a share. And if you look historically, they were close to that 30s number. But I don't think they're there. I think even though the model is saying this is a buy, I would be really concerned because they have so much debt, and if they can't pay or if their revenue slips at all, they're going to have a really difficult time getting through that. So the model says it's a buy, but you can't always trust the models. You have to also trust what you feel and how you understand the markets. Because this is just looking at the past. We have to look into the future of the company. And let me know what you think in the comments. Do you think this is a buy or a sell? And let me know if you want to do another type of video. Thanks for watching.